Other question now, though, however, is what does that mean for the top four banks, right? Because if it's $2 trillion for everybody else but the top four, what's the gap for the top four? That looks like it's somewhere between $1 trillion and $2 trillion. So that's another amount of money we're going to have to, or the Fed will have to backstop.
It's not exactly news anymore that the Silicon Valley bank crash is the second largest bank failure in US history. But Chamath Palihapitiya, a venture capitalist who has his fingers in several Silicon Valley companies, says that this is much bigger than just SVB. There is danger lurking, and we may see a ripple effect that will cut across several major industries and the biggest companies. So what are we missing so far in the SVB story? That is what you're about to find out. And of course, be sure to click that subscribe button the way depositors clicked the withdrawal button when they took their money from SVB. Let's go over to Mr. Chamath to learn exactly how serious this event really is.
I think the issues at Credit Suisse are different than the issues at First Republic. And the issues at First Republic are different than those other three banks. The other three banks, David, that you mentioned, Signature, Silicon Valley Bank, and Silvergate, all had very traditional liquidity crises, right? We talked about this last week, which is duration mismatching, where you have depositors who want their money today, but you have assets that mature in 10 years. And as a result, you have huge unrealized losses if you all of a sudden cash them out today versus waiting 10 years. I think what's happening at First Republic is really just about making sure that that loan book and the depositors can get parked into a combination set of banks that can take care of the balance sheet so that there are no more liquidity issues. At Credit Suisse, they have an enormous amount of liquidity. What that was I think, a lot of speculation around whether they would default on their bonds or whether they would theoretically need more liquidity. But the balance sheet itself was not only liquid, but also very solvent. So I think that was just more of a panicky reaction to comments from a 9.9% shareholder who just said that they can't put in any more equity. But even then, I went back. This is the chairman of the Saudi National Bank. He was asked on Bloomberg, would you give Credit Suisse more money? And he had a very reasonable answer, but it was snapshotted in a very awkward way. The first sentence was, under no circumstances would he do that. Okay. Now, if you stop there, you could be panicked. But the rest of it made a lot of sense, which is he said, look, in Saudi Arabia, if we go above 10%, we have to go through regulatory approvals domestically, and there are regulatory approvals abroad. That's a big hill to climb, and all of a sudden, it no longer becomes a financial investment. It becomes a somewhat political investment. And so we're very happy at 9.9%. That was the totality of his statement, but if you just cherry pick the first 45 seconds and ran with it, which people on the internet did, this is sort of what caused that second level wave panic at a GSIB. And then the Swiss National Bank stepped in, and I think that panic has largely gone. Okay, so what is the real issue? The issue, again, is I think we have had a bit of supervisory failure here, right? Because we all know this in any industry. If you let capitalism go totally unchecked, shareholders will demand immediate profits today. It happens in every industry, except in ones where you can basically gamble on future profits, and that's what tech does. But every other shareholder in every other asset class demands money today, and that's the same for banks. The problem is the banks are a highly regulated business. They are supposed to be supervised by the regulators. And this is a very clear example where why is there not a real-time spreadsheet? I mean, this is not complicated stuff where assets and liabilities and duration mismatching can be known on a real-time basis, where the San Francisco Fed, Mary Daly, should have a report that's escalated to her when SVB got over their ski tips, which they did in Q4 of 2022. So I think the real question that has to be examined is, where were these folks for the last 4 months when they could have done something, not just about this, but rules in general for all banks that are not the GSIBs?
Something serious is happening, and it's happening fast. First, we had Silvergate, which was a crypto-centered bank that collapsed early in March after the bank published that their financials were in the negative after they suffered heavy withdrawals from customers. In January alone, over $8 billion was withdrawn. A few days later, from March 8th to March 9th, customers withdrew about $42 billion from Silicon Valley Bank, all within one day. But that wasn't all. SVB's stocks had lost 62% of their value as well. On the 10th of March, it was official. Silicon Valley Bank had failed. 2 days after, Signature Bank would also fail and be taken over by the Federal Deposit Insurance Corporation, or FDIC. Now, this is what makes these events even more interesting. SVB is the second largest bank failure in US history, and Signature Bank is the third largest bank failure in US history. Can you connect the dots? Two bank failures of historical proportions happening within 2 days of each other is no coincidence. Definitely, there were signals that showed this was going to happen, and yet, it was just allowed to happen. So, are we really safe even now?
I think the critique is specific to Silicon Valley Bank because I think, and this article was in the Wall Street Journal, but what it shows is a really complicated, intertwined relationship between VCs and Silicon Valley Bank, where VCs were given very cheap interest rate loans. They were given GP call lines of credit. They were given LP lines of credit. And then those same VCs would be directing their companies to put their deposits inside of SVB, who would then take those deposits and buy risk. Yeah. And while the reality is all of this stuff will come to light because I think it will get exposed as we go through congressional hearings on all of this. But I think pointing the finger at VCs in this specific case is somewhat warranted because there was a little bit of people working in lockstep together, and there was a lack of functional responsibility around how to be a true fiduciary. So if you come to a board and your founder is 22 years old and you give that person $15 or $20 million, I think it makes a fair amount of sense that you are supposed to be the more sophisticated financial person in that room. And if you have incentives that aren't properly disclosed to that CEO, and now a set of decisions are made, I think that there should be some accountability for that, or at least some exploration of why that happened.
Venture capitalists are fast becoming a huge problem for all markets. Remember their reckless participation in FTX? This time around, SVB failed because venture capitalists started the panic that led to the bank's collapse. We had investors like Bill Ackman who took to his Twitter handle just to spread panic. Even Elon Musk agreed that the panic was unnecessary and SVB's collapse was preventable. If venture capitalists keep creating panic like they did in the case of SVB, we could be at the verge of seeing more companies go down just because of alarmist VCs with their huge influence in the investment world.
So all of these banks basically have assets that they bought for $1 and are now worth 95 cents. And that's what's creating this whole issue, or 80 cents or 85 cents. You pick the number, but they're not worth the $1 that they bought it. What the Fed basically said is, okay, give me that asset, give me that bond. I will value it at $1 and I will give you $1 as a loan and you will pay me interest. And the interest rate, I think, is what's called OIS, and they added 10 basis points on top. So I think it's about 4.9%. So what it allows all of these banks, and if you take all of the banks that are not the top 4 in America, so the top 4 are JP Morgan, B of A, Citi, and Wells. So just ignore those for 1 second. The other N banks, if you look at all of the assets that are underwater because of all the rate hikes that Sachs talked about, and you add up all those losses, that is about $2 trillion. And the Fed didn't announce that there was a beginning and an end to this program other than saying these would be one-year loans. And so I think the exposure for the American banking system at a minimum is going to be this $2 trillion because now the incentive, if you're a banker right now running one of these banks that has not gone under, is to immediately go to the Fed, put all of those assets to them, get a loan, and now take that and buy different assets, different bonds, different US treasuries that are yielding much more than what your old treasuries were yielding. And I think that's the arbitrage that we've unfortunately created. And the other question now, though, however, is what does that mean for the top 4 banks, right? Because if it's $2 trillion for everybody else but the top 4, what's the gap for the top 4? That looks like it's somewhere between $1 trillion and $2 trillion. So that's another amount of money we're going to have to, or the Fed will have to backstop. And then, as Friedberg said, these checks always come due. what do we do in a year? Because in a year, the problem is the only way to make the banks in a position to repay this much money in 1 year is to cut interest rates so massively that these assets massively inflate, and now all of a sudden you're in a position to cover this.
If there's any lesson we can take away from the collapse of SVB, it would be that no company is too big to fail now, and until the Fed tightening stops, many other companies are at risk of failing, and we're sure to see more businesses fail, even in the crypto market. But what about you guys? What are your thoughts on the whole SVB situation? Be sure to let us know in the comment section below. And of course, give this video a big ol' thumbs up to give it more exposure, and remember to check out our other content if you want more news on the economy and the crypto market.